Welcome back to the Deep Dive. It is Tuesday, January 27th, 2026. Today, we aren't just looking at a company. We're looking at something that it resembles a tectonic plate of the American economy. If this thing shifts, the whole country feels it.
It's true. We are talking about United Health Group, ticker symbol UNASA. And the scale here is, well, it's hard to overstate.
I was looking at the numbers before we started. This company touches the lives of roughly 150 million people. 150 million. That is nearly half the population of the United States. If United Health Group were a country, its revenue would rival the GDP of, a mid-sized European nation like Austria or Norway.
Exactly. It is a massive engine. But, and this is why we're doing this deep dive today, even massive engines can sputter. We're looking at their Q4 2025 earnings, which just dropped, and it's a fascinating story of contrast.
It really is. On one hand, you have revenue numbers that are absolutely skyrocketing, but on the other, the profit for the fourth quarter, basically evaporated.
It vanished. Yeah, it's one of those Dr. Jekyll and Mr. Hyde earnings reports I've ever seen.
So our mission today is to unpack exactly what happened. Is this a stumbling giant that's, losing its way? Or is this just a messy quarter that's hiding a massive buying opportunity? We're going to tear apart the numbers, look under the hood at their business model, which is way more complex than just insurance, and finally figure out what the stock is actually worth.
We're going to strip it down to the studs.
But before we get into the billions, we have a specific tool to help you track the broader market context.
That's right. To track total market temperature, welcome to search and download the iOS app Buffett Indicator from the Apple App Store.
And as always, we need to get through the legal housekeeping before we dive in.
All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. The content is for educational purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions. If you want to listen to our full deep dive about this topic or access more advanced contents, welcome to join Deep Value Club membership or subscribe us on Apple, Spotify Podcasts channel, Deep Value Investing and deepvalues.ai.
All right, housekeeping done. Let's get into the crime scene. We're looking at the full year 2025 and specifically this very strange fourth quarter. Hit us with the headline numbers.
Let's start with the wow number, the top line revenue. For the full year 2025, United Health Group brought in $447.6 billion.
$447 billion.
That represents a 12% increase year over year. I want you to just pause and think about how difficult that is.
Right.
When you are already generating $400 billion, finding another $50 billion in growth is mathematically incredibly hard. It's like a sumo wrestler running a sprint.
Right. Usually companies that size grow at GDP rates, maybe 2 or 3%. They're growing at 12.
Precisely. The insurance division alone, United HealthCare, grew sales by 16%. So, strictly speaking, the demand for their product is not the problem. The cash register is ringing off the hook.
Okay, so they're bringing money in the front door, but then you look at the bottom line for Q4, and it feels like someone left the back door wide open.
This is the ouch number. GAAP earnings per share, that's the strict by-the-book accounting profit, came in at 1 cent.
A penny.
One single penny of profit on $113 billion of quarterly revenue.
That is baffling. If I'm a shareholder, I'm looking at that penny and I'm panicking. Did they lose the money? Did they burn it? How do you make $113 billion and keep 1 cent per share?
Well, they didn't lose it in terms of operations failing, but they spent a fortune cleaning up a mess. They took a massive $1.6 billion after-tax restructuring charge in the quarter.
$1.6 billion is a lot of cleaning up. What exactly went wrong?
It's a kitchen sink quarter. They threw everything bad into this one report. They sold off some underperforming units in South America portfolio divestitures. They reorganized some internal operations. But the biggest culprit, the one that really hurts, is the fallout from the cyber attack.
Ah, right. The big hack. This is the Change HealthCare attack from back in 2024, right? We're still paying for that in 2025.
We are. You have to remember, that wasn't just a data breach where someone stole some emails. That attack effectively froze the plumbing of the U.S. healthcare system for weeks.
Wow.
Doctors couldn't get paid. Pharmacies couldn't process claims. Fixing that, paying out the claims manually, upgrading the security infrastructure, it cost them about $800 million in this quarter alone.
So it's like having a pipe burst in your house. You have to pay the plumber, you have to replace the drywall, and you have to buy new carpets. It's just a massive one-time cash drain.
Exactly. And that's why management is telling investors, don't look at the penny. They're pointing to the adjusted EPS.
I always get skeptical when companies say ignore the bad stuff. Is this just financial engineering? Or is there some merit to it?
In this specific case, I think there is merit. If you strip out the cyber attack costs, which hopefully is a once-in-a-lifetime event, and the restructuring for selling off those foreign divisions, the adjusted EPS was $2.11 for the quarter.
Okay.
And for the full year, adjusted earnings were $16.35 per share.
So if the pipe hadn't burst, the house would still be generating rent. The underlying business is still profitable.
Correct. The engine is still running. It just spent the quarter in the repair shop. And looking ahead, management is confident. They raised their outlook for 2026. They're forecasting revenue of roughly $439 billion, a slight dip because they sold those foreign divisions.
Right.
But they expect adjusted earnings to jump to over $17.75 per share.
So they're signaling that the margins are going to snap back.
They're telling the market the worst is behind us.
Let's pivot to the business model itself, because I think this is where people get confused. I think most people hear United Health and they just picture that insurance card in their wallet. They think, okay, they collect my premiums, they pay my doctor, and they keep the difference.
That is the traditional view of insurance. And if that is all they did, this company would not be the monster it is today.
So what are we missing? What is the real machine here?
You have to understand that United Health Group is actually two massive, distinct companies stitched together. You have United HealthCare, which is the insurance arm. That brings in about 79% of the revenue. They have nearly 50 million members.
Which is huge, but insurance is a low-margin game generally.
It is. The margins are tight and they're regulated. But the secret sauce, the real profit engine, is the second arm, Optum.
Optum. I see that name everywhere now. Optum Urgent Care. Optum RX.
Optum is the health services arm. It accounts for about 21% of revenue, but the margins are totally different. Optum isn't insurance. Optum is the doctor, the pharmacist, and the data analyst.
Wait, unpack that for me. So United insures me, but they also own the doctor I go to.
Yes, through Optum Health.
And they own the pharmacy that fills my prescription.
Yes, through OptumRx.
And they own the data company that processes the claim.
Through Optum Insight. This is what we call vertical integration. And it is their massive competitive moat.
It sounds, well, let's be blunt. It sounds like a conflict of interest. If the insurer owns the doctor, doesn't the insurer just tell the doctor to provide less care to save money?
That is the regulatory concern, yes. And it's why the government watches them like a hawk. But from a purely business perspective, it's brilliant. Think about the Affordable Care Act, Obamacare. It capped how much profit insurance companies can make.
Right, the medical loss ratio.
Exactly. For every dollar of premium, they have to spend roughly 80 or 85 cents on care. They can't just pocket it.
Right, the government put a ceiling on their profits.
So what did United do? They said, okay, if I have to pay 85 cents to a provider, I might as well pay my own provider.
Oh, that is clever. It's an arbitrage.
It is. The money leaves the left pocket United HealthCare and goes into the right pocket Optum. It all stays in the house.
And I imagine this gives them incredible power over pricing.
Immense power. Take OptumRx. They process over 1 billion prescriptions annually.
A billion.
A billion. When you're buying that many of anything, you can demand rock-bottom prices from drug manufacturers. But you can still charge the market rate to the employers. That spread is pure profit.
So it's a walled garden.
A very profitable walled garden. And it creates these network effects. They have 1.5 million physicians in their network.
Right.
If you're a big employer, say General Motors, and you want to buy insurance for your staff, you almost have to go to United.
Right.
If you switch to a smaller insurer, half your employees might lose their doctor. The switching costs are incredibly high.
Okay, so the model is robust. It's a money machine. But we established at the top that the stock has been wobbly. It wasn't just the cyber attack. There are other things spooking investors, right?
Yes. There were three main headwinds hitting them in 2024 and 2025. The first was a utilization spike.
Utilization. That's industry speak for people actually going to the doctor.
Exactly. Think back to the pandemic years. Nobody got knee replacements. Nobody got elective surgeries. People were afraid to go to hospitals.
So we had a backlog of broken knees.
A massive backlog. And in 2024 and 2025, the dam broke. Everyone came back for those surgeries at the same time.
Which means United had to pay out a lot more claims than they expected.
Right. Their medical care ratio, or MCR, jumped to nearly 89%. That means for every dollar they took in, 89 cents went out the door. That compresses margins significantly. It's great for patients finally getting care, but it's terrible for short-term profits.
But that should be temporary, right? Once the knees are fixed, they're fixed.
Theoretically, yes. That's the short-term headwind argument. But the second issue was leadership, and this one rattled Wall Street. In May 2025, the CEO, Andrew Whitty, stepped down unexpectedly.
Unexpectedly is a word investors hate. It implies chaos.
It does. Usually succession at a company this size is planned years in advance. This felt abrupt. To stabilize the ship, they brought back the old guard, Stephen Hemsley. He was the CEO years ago and was serving as chairman.
It's like bringing the retired general back to the front lines because the new guys aren't ready.
That is a very apt analogy. Hemsley is the architect of the Optum strategy, so the market respects him immensely. But it raises questions about the future. Who is next? You can't rely on the retired general forever.
And the third headwind, I assume it involves Washington, D.C.
Always. The government is tightening the purse strings on Medicare Advantage.
Which is the private version of Medicare that United runs.
Correct. It has been a huge growth driver for them. But the government is changing the reimbursement rates for 2026. United expects a greater than $6 billion hit from those changes.
$6 billion is not a rounding error.
No. And deeper than that, you always have the existential threat. As long as healthcare costs keep rising, the political pressure for a single-payer system, or Medicare for all, increases. If the private insurance market is legislated out of existence, UNH's business model evaporates overnight.
That is the dark cloud that always hangs over the stock. Okay, so let's recap. We have messy numbers from hacks and restructuring. We have a brilliant business model in Optum. But we have headwinds from utilization and regulation. Let's get to the bottom line, the investment case.
Let's look at it through the lens of a deep value investor. Let's use the Buffett checklist from our source material.
Okay, if Warren Buffett were looking at UNH today, would he buy it?
Let's start with valuation. Buffett likes cheap. Is UNH cheap?
I'm looking at the price-to-earnings ratio. It's around 25x.
Right, and if you use the depressed 2025 earnings, it's over 30x. Historically, deep value investors want a PE below 15.
So it's nearly double the bargain price.
It is. The price-to-book ratio is 3.3x. A bargain hunter usually wants that under 1.5. So strictly on price, it fails. It's expensive.
But Buffett also famously said, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Is this a wonderful company?
That is the yes column. The quality metrics are stellar. Look at return on equity. The 10-year average is about 22%.
22%. For a company with almost $500 billion in revenue, that is absurd efficiency. Usually, as you get that big, you become sluggish.
It's the Optum machine at work. And the cash flow backs it up. This business is a cash cannon. Free cash flow usually exceeds net income. Even in a bad year like this, they're generating over $16 billion in free cash.
And I know from their filings, they aren't just sitting on that cash like a dragon on a gold pile.
No, they are what Charlie Munger would call cannibals. They eat their own stock. They have retired about 100 million shares since 2015 via buybacks, plus 16 consecutive years of dividend growth. They treat shareholders very, very well.
So we have a high-quality machine, but a high sticker price. Let's try to find the actual number. What is it worth? We have a discounted cash flow analysis from our sources.
All right, DCF is just a fancy way of asking, how much cash will this company generate in the future, and what is that cash worth to me today? We have 3 scenarios.
Let's start with the pessimist, the sky is falling scenario.
This assumes the headwinds we discussed. Government regulation, utilization, size limits, stop the growth permanently.
So a flat line, $16 billion a year forever.
If they never grow again, the intrinsic value of this stock is about $172 per share.
And it's trading around $284 today.
So if you think growth is dead, you're overpaying massively. You'd be buying $1 for $2.
Okay, that's the bear case. What about the nominal scenario? This assumes they get past the messy 2025 and return to their historical trajectory.
Historically, they've grown free cash flow at about 10–11% annually.
Is 10% realistic? Can you really grow 10% when you're already $500 billion?
That is the big risk. But if you believe they can, by squeezing more out of Optum or expanding into value-based care, then the intrinsic value is around $458 per share.
Wait, 458?
No.
And the stock is at 284.
Correct. That implies a roughly 38% margin of safety.
That is a massive gap. Usually large companies are priced pretty efficiently. This suggests the market is very confused.
It's the aha moment. The market is pricing UNH somewhere in the middle. It's saying, we don't think you're dead, but we don't believe you can grow at 10% anymore.
So the investment thesis is actually pretty simple. It's a bet on the machine.
It's a bet on Stephen Hemsley and the vertical integration model. If you believe the cyber attack and the utilization spike were just one-time glitches, you are buying a compounder at a significant discount. You're buying a Ferrari that's being sold at a Toyota price because it has a flat tire.
But if you think the engine is blown, if you think peak insurance is here,
Right.
you stay away.
Precisely. At $284, you're paying for growth. If the growth doesn't materialize, there's no safety net.
That is a fascinating setup. It's rare to find a blue chip stock where the bull case and the bear case are so clearly defined by a single variable growth rate.
And that's what makes it a deep value candidate in a weird way. It's not cheap because the company is trash. It's cheap because the market is uncertain about the future speed of the engine.
So let's wrap this up. United Health Group, dominant scale, wide moat via Optum. 2025 was a messy year. Charges, hacks, CEO shuffles. But the cash flow remains enormous.
And the valuation offers a potential 40% upside if, and this is big if they return to form.
I want to leave our listeners with a final thought to chew on. We talked about how United is betting big on owning the clinics and the data. They're effectively privatizing the management of U.S. healthcare. But here's the question. With political pressure mounting on healthcare costs, can a company this size continue to extract 20% returns on equity forever? Or have we reached a point where the sheer size of UNH becomes its own enemy, painting a target on its back for regulators?
That is the multi-billion-dollar question. When you are the size of a nation's GDP, growth requires finding new frontiers. And in healthcare, those frontiers are often guarded by politicians.
Something to mull over. Thank you all for joining us on this deep dive into United Health Group. If you want to dig